In today's Asia session, the S&P 500 E-mini futures as well as the Nasdaq 100 E-mini futures managed to stage a modest bounce of 0.1% to 0.2% after yesterday's Thanksgiving holiday break, where we see the closure of the US cash stock market. And in today's early Asia session, spot gold XAU/USD managed to stage a rally of 0.7% as it inched back up close towards the 4,200 psychological level. Happy Friday and very good morning to all. I'm Kelvin here. Welcome back to your daily dose of market insights. Today will be Friday, the 28th of November 2025. So as usual, before we kickstart our gist of today's daily dose, let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so as usual, before we jump into the gist of today's daily dose, which will be a much of a condensed version due to the lower volatility that we are seeing right now and yesterday's session due to the Thanksgiving holiday. For today's session, I will not cover all the intraday technical outlook on the major cross asset classes that we did at the start of this week until yesterday. Thursday, I will actually pick a couple of charts to actually share with you guys as my chart of the day. But before we jump straight into that, let me share with you what are the key data events that has taken shape yesterday and as well as in today's early Asia session. So yesterday was actually a very quiet session that I mentioned due to Thanksgiving holiday in the US, but we do have one important news flow data that came out, which is the release of ECB monetary policy minutes from the previous meeting last month. So during this minute, officials actually highlighted that they saw the current rate level as robust enough to manage shocks. So bear in mind that ECB has started a much more earlier interest rate cut cycle this year as comparatively to the US Federal Reserve. And in the last three meetings, they decided to keep their interest rate policy on hold. That means they didn't cut and pause it for a pause. And they do mention that over here is that in terms of on interest rates, all right, the governing council medium-term orientation mean that it's important to avoid excessive focus on the very near-term outlook, even though the governing council had a clearer view outlook of those shorter horizon over here. And also he mentioned that the December meeting, which is the next coming one next month, will allow the governing council to update its assessment on the distribution and the intensity of risk. So the December meeting will be primarily very important. And the view was expressed that the rate cutting cycle had come to an end. All right, since the current favorable outlook was likely to be maintained unless risk materializes. So this was the debate that they have in the previous meeting. And at the same time, the view has also expressed that it was important to remain entirely open-minded on the possible need for a further rate cut, that such a move was likely to be warranted if there was an increase in the likelihood or intensity of the downside risk factor or the projected undershooting of the inflation target become sustained. So what you see over here is that in the previous meeting, majority of the officials has a view, ECB official, I would say, has a view that the interest rate cut cycle that kickstarted earlier than the US Federal Reserve in Eurozone is likely to come to an end. So that's why they have a pause in the last three meetings in terms of their interest rate cuts. So they held interest rate steady for three consecutive meetings. And they also mentioned that the December meeting will be very important. Why? Because it will allow them to see whether there is any increase in downside risk factor. And also in the December meeting over here, where is it? Let me share with you guys. Yes, so in the December meeting, they will actually provide fresh quarterly forecast that could point to inflation undershooting the target in the year end. All right, and also in the December meeting, they also were actually, it's not here, it's in the minutes. In the December meeting, they were actually release projection way far into 2028 as well. All right. So with that, that means projected for 2026, 27, and 28. So with that, if inflation growth target for 27, 28 came down below the 2% target that ECB officials we call it desired, that could actually give a hint to market participants that the interest rate cut cycle may come into the forefront again in the later part of 2026. So market participants for now are actually watching much more closely in the December meeting, where ECB will release their latest longer term inflation and growth forecast for 2027 and as well as 2028. So if there's any signs that if inflation growth forecast for 2027 and 2028 come down below the 2% target that ECB officials desire as a healthy rate of inflation, that could actually increase the odds of another interest rate cut cycle coming into the later part of 2026. So for now, market participants still has a view that more or less ECB officials has more or less done with their current interest rate cut cycle, unless there is a downside risk that starts to materialize. And to understand what downside risk is being materialized or in the near term, on the near horizon or in the longer horizon, we got to wait for the December meeting where they will release their latest longer term inflation and growth forecast for 2026, 27, and 2028 over here. All right, and also in today's Asia session, we see the release of several key Japanese economic data that could potentially sway the or influence the Bank of Japan monetary policy stance. And bear in mind that the Bank of Japan monetary policy stance is in the hot potato right now, given the fact that the current Japanese administration is in favor of a easing monetary policy, but the current monetary policy stance dictated by BOJ is more of a normalization policy where they favor a gradual interest rate hike. And so far, Bank of Japan only hiked interest rate at the start of this year to bring the short-term benchmark rate to 0.5%. And until now, they keep rates on hold. And given the new administration that has came in in Q3, Q4 this year, the interest rate cut hikes dictated by the swap market in Japan has reduced. That means market do not see Bank of Japan cutting Bank of Japan hiking rates, no, pardon me, Bank of Japan hiking rates in December. So they push it forward to January instead. So if you look at the Japanese latest Tokyo core CPI data, so Tokyo core CPI data is being used as a leading economic, we call it leading inflationary trend to give a kind of a leading turning point for the overall nationwide Japanese trend that will the nation one, the Japan CPI trend that will be announced 3 weeks from now. So the Tokyo one for November came in above expectation. So market is expecting at 2.7, it came in at 2.8%, same pace with the previous month of October on a year-on-year basis. So if you strip out the Tokyo core in Japan, they call it core CPI and core. So core CPI exclude food and energy. All right. So the core rate that is much more important, which BOJ watches more closely, that strip out both the volatile items of food and energy, also came in within previous month pace at 2.8%, similar. So if you look at the trend of the core Tokyo CPI for the month of November, is hovering rather steadily based on the 10-year trend. All right. So it's hovering steadily since April this year, all right, above the 2% long-term inflation target that Bank of Japan desired. And also other growth-related economic data also came in better than expected. All right, so if you look at the industrial production year-on-year figure for October, sorry, give me a minute. Where is the industry? Yeah, this is the industrial production. Okay, industrial production month-on-month, preliminary, it came in at 1.4% year-on-year, more than what market is expecting. Market expecting a negative 0.6% month-on-month growth. Okay, it's not year-on-year, it's month-on-month growth. So month-on-month growth, market is expecting negative 0.6%. I repeat, but it came in at positive 1.4%, which is a rather positive scenario that supports that industrial production in Japan is growing for the month of October. And also retail sales that represent consumer spending. Retail sales year-on-year for October actually grew way above expectation. So market is expecting only an uptick of 0.8% from 0.2% in the previous month of September, but it came in way above expectation for the month of October. So retail sales expanded at 1.7% year on year for October. So that represents that there's some signs of positiveness on the demand side of this economic indicator for Japan, industrial production and retail sales, coupled with a rather healthy inflation trend in Tokyo's core CPI. All this actually supports the ongoing Bank of Japan monetary policy normalization guidance. That means on the path of slowly, gradually increasing interest rate. So that actually also put the dollar strength in check in the dollar yen. All right, so the dollar yen since this week it starts to float down below the 15850 level. So as we are speaking right now, the dollar yen is trading currently almost unchanged at 156.27. All right, 156.27. So later I'll share with you the key levels to watch out for the dollar yen chart over here. So that covers the first segment of the daily dose. Okay, let me immediately move on to the second segment. Very quickly, let me touch on some of the charts on the FX market. All right, over here. So in the FX market over here, let's take a look at the dollar index first in the first place. So the dollar index continues to trade below the 20-day and the 200-day moving average, which is very important because what it means that there's this bearish reversal taking shape at the top, at right exactly at the retest of this complex medium-term upper limit of the range resistance, which is my medium-term resistance level, upper limit at 100.54, before shaping a series of spinning top candlestick on 20th of November to 24th of November, before that bearish reversal candlestick took shape on this Tuesday and Wednesday, and yesterday Thanksgiving holiday, and in today's ex-post Thanksgiving holiday, we saw a lower tends to be a lower liquidity trading environment as well. Price action still continues to hover below the 200-day and the 20-day moving average, indicating that the dollar index may face further downside risk towards the middle part of this sideways range configuration at 99.25 and 99.66 over here. All right, which is this complex medium-term sideways range configuration that has taken shape since the low of 1st of July. All right, so this for the US dollar index on a daily chart basis. So back to the dollar yen, I'm going to share you guys. So the dollar yen, yesterday we do have a pivotal support level, pivotal resistance level, not support level, at 156.75 over here. So 156.75 still remains my short-term pivotal resistance level, given that the price action continues to shape a lower higher over here. So what you can see, let me put it in, let me draw it for you guys to see over here. Put this in pink. Okay, this high lower than the high that got rejected at the Titan pivotal resistance that I have yesterday. So still no change. Still watching 156.75 as my short-term pivotal resistance on the dollar yen. A breakdown below this key intermediate support level that managed to survive in yesterday's European session. Exactly that we highlighted 155.95. A breakdown below it exposes the next near-term support at 155.25, 155 figure level, which conflues with the 20-day moving average. All right, so that's for the dollar yen. So right now, let me share with you my chart of the day for today. So my chart of the day today will be one of the major benchmark US stock index, which will be the S&P 500. So we know that S&P 500 yesterday has a lackluster session over here. So right now, the S&P 500 is now testing this upper limit of this dotted gray line here, which is the descending trend line taken from the current all-time high that was printed previously on 30th of October. And what's interesting over here is that in today's Asia session, we see a bounce of a parallel key ascending trend line support level drawn on the hourly RSI over here, and it now starts to show a higher low as we are speaking. All right, this low here is turning up. We highlight in green right now. And this low here, right, is turning up over here, and put it in parallel. This parallel ascending trend line on the RSI also correspond to the minor ascending channel support that I draw on the hourly SPX 500 raw price action chart over here. So what I could see is that the price action on the hourly RSI is now bouncing off the lower limit of this minor ascending channel support, also parallel to this ascending trend line that I draw on the RSI, that very clearly starts to shape a higher low. So indicating that upside momentum has now starts to build up on the SPX 500. So with that in place, this will be my chart of the day, given that there could be a potential breakout above 6,830. So I'll be using a Titan adjusted short-term pivotal support zone for today at 6,780 slash 6,760, which confluence with the 20-day moving average as well. Clearance above 6,830 may expose 6,880 next. Then thereafter, we may see a retest on the 6,930 current all-time high level in the coming days potentially. However, if we start to see a bearish reversal and a breakdown below 6,760, that would invalidate today's bullish bias stance on the SPX 500, which is my chart of the day, and that could see a deeper corrective minor pullback towards 6,710, followed by 6,660, maximum 6,710, 6,660, maximum 6,610 next. All right, so this will, if I do the Fibo retracement over here, that also constitute closely to the 50% and the 61.8% Fibo retracement as well. All right, so that's will be one of my chart of the day, which is the SPX 500. The next chart of the day will be considering the one of the commodities market, which is the precious metal, gold. So at my start of my daily dose, I mentioned that gold suddenly did a rally in today's Asia session. So yesterday we were neutral over here because of that bearish divergence previously that was highlighted in gold, which I highlighted. So, but this bearish divergence has been invalidated after a strong breakout and a bounce off a parallel ascending trend line on the hourly RSI, indicating that there's this upside momentum or bullish momentum that starts to creep back on the shorter term for gold XAU/USD. So with that bearing in mind, I will have a bullish bias for today for gold XAU/USD, given the current positive technical elements that has been depicted on gold on the hourly chart in today's Asia session. First support level to watch will be yesterday's European session low, and also yesterday's US session low at the 4,142 level. Pivotal support level will be at 4,105. So as long as this 4,105 short-term pivotal support holds, potentially goals may seek a series of higher high, a clearance above 4,208 may reinsert the bullish biasness in short term towards 4,267 next. All right, so 4,267 is correspond to the 76.4% Fibo retracement of that previous down move from the all-time high of 20th of October to 28th of October low level. And if you do a Fibo retracement, Fibo extension from the 28th of October low to the high of 13th of November, project it down to the recent recovery from 18th of November low, that also confluence with the 0.764 Fibo extension, 0.764 Fibo, 0.764 Fibo extension as well, very closely at 4,267. All right, so that's for gold, which is my chart of the day as well, but only a bearish breakdown below 4,105 that will invalidate today's intraday bullish bias on gold to see a deeper slide back towards 4,038, which is the minor swing low area of 20th of November to 24th of November, which is managed to survive last week. All right, so these will be my two charts of the day for today. One will be the US SPX 500, followed by gold XAU/USD due to its prominent, interesting short-term technical elements which I highlighted to you guys. So before we go, let's take a look at the economic calendar. What are the key data to look out for today? And bear in mind that in today's US session, yes, US session, the stock market is open for trading today, but they only open for trading in the first half of the US session, and they will close in the afternoon. So there will be also a lower liquidity going forward in the US session today. After the Singapore time will be that after that 1 a.m. to 2 a.m. mark, all right, once the first half of the day has passed in the US session. So other than the US closure for its Black Friday holiday today, half day in terms of US closure of the financial markets in US, we do have a couple of European data interesting to look out for that's coming up at 3:45 p.m. Singapore time. So that will be various key Eurozone major economies preliminary inflation data that will be out for the month of November, starting with France at 3:45 p.m. Singapore time over here. So market participants will be looking at the harmonized inflation rate. So that is will be the core inflation rate, pardon me, core inflation rate for France. So for the month of preliminary month, it's a flash inflation data for the month of November. So market is expecting an uptick for France year-on-year data for November, a core inflation rate up to 1% to 0.8% previously for the month of October. And if we stretch down to later part of the European session, we have the Germany inflation data out as well. So Germany harmonized inflation rate data, that's the core inflation rate data for Germany for the month of November, a flash rate, is a preliminary rate that will be out at 9 p.m. Singapore time. 9 p.m. Singapore time, so that market also expecting a slight uptick to 2.4% year-on-year from 2.3% year-on-year in the previous month of October. So market participant is now pricing in a firmer inflation trend in these two key major Eurozone economies, which is France and Germany. And if it came in above market expectation, that could actually further solidify the ongoing dollar weakness in the FX market. That means i.e. euro dollar strength going forward. All right, so with that, that sum up today's daily dose of market insights, a shorter one today, given the lower volatility that we see across the market, across the global asset classes. I'm Kelvin here, wishing you all a great Friday ahead and a restful weekend, and we shall speak again on Monday. Thank you very much.